Welcome back, everyone, for another deep dive. It's pretty amazing to me how a book published way back in 1949 can still be so relevant in today's market. But The Intelligent Investor, well, it really does offer some timeless wisdom, and we're going to be unpacking some of that today.
Oh, absolutely. Benjamin Graham's insights, they've really stood the test of time. The principles he laid out in the book, they're just as valid in today's crazy market as they were decades ago.
So let's start with the foundation. Who is this intelligent investor Graham keeps talking about? It's not just about, like, being some Wall Street whiz, is it?
Not at all. Graham really emphasizes that intelligence in investing is more about temperament than, some kind of like super high IQ.
Hmm.
He says it's more about, having the patience to actually sit down and do your research, the discipline to actually stick to your plan, and the independence to think for yourself.
That makes a lot of sense. It's more about making decisions based on, rational thought than getting swept up in the hype or panicking when the market takes a dip.
Exactly. And to illustrate this, Graham, he shares a really interesting story from his own early investing days. It's about a company called Seville Tire. And Graham, he saw this stock just skyrocket, like 250% on the very first day of trading.
Wow, that's an amazing gain.
Yeah, it sounds like a dream come true.
Yeah.
But there is a twist.
Oh,
Within a few months, the stock completely plummeted. And Graham, well, he ended up losing everything he invested.
ouch. That must have been quite a harsh lesson to learn.
It was, but, he realized that that initial success, it wasn't real. It was all driven by speculation, by getting caught up in the excitement without really understanding, the actual business he was putting his money into.
Yeah.
And this whole experience, it actually became this pivotal moment for him. It's really what led him to develop his core principles of, value
No,
investing.
makes sense. It highlights the danger of chasing uh, quick profits without doing your research first.
Right, right. And that actually brings us to one of Graham's most important distinctions, which is, the difference between actual investing and speculation.
Okay, let's break that down because I think a lot of people use these terms interchangeably, but Graham draws a clear line between them.
He does. He defines investing as a very thorough process. You research the company, you understand its intrinsic value, and then you buy it at a discount with a margin of safety. Speculation, on the other hand, is more about trying to predict, those short-term market movements,
Hmm.
and often based on, things like just rumors or, just getting emotional about it all.
Hmm?
So it's kind of like the difference between, building a house on solid ground versus building it on sand.
Yeah.
And to really emphasize this, Graham points to this real world example from back in 1962. There was this group of investors who were like absolutely convinced that the market was going to crash.
Uh-huh.
So they started selling stocks short.
Selling short, meaning they were betting that the stock price would go down.
Exactly. They were borrowing shares, selling them, and then hoping to buy them back, at a lower price later.
Yeah.
But their prediction backfired big time.
Hmm.
Instead of crashing, the market actually went on a major upswing.
Oh, the irony. So they actually lost out by trying to time the market.
They did. Graham, he uses this example and many others to argue that trying to predict, like those short-term movements, it's a fool's errand. It's just not possible.
Hmm. So what's the alternative then? What's the intelligent investor do to kind of sidestep all these pitfalls?
It's about focusing on what they can control, which is understanding the true value of those businesses they invest in.
Right.
And this is really where the whole concept of intrinsic value comes in.
Right. Tell me more about that. Intrinsic value.
So intrinsic value, it refers to the true worth of a business based on things like, its assets, its earnings, its future prospects. And Graham, he emphasizes that the intelligent investor isn't swayed by the whims of the market. They do their own research to figure out what a company's really worth, regardless of what the stock price might be at this exact moment.
So it's like being a detective in a way.
Exactly. And once you've got like a good grasp of that intrinsic value, then you can start looking for opportunities to buy it at a discount. And that's where this idea of the margin of safety comes into play.
Now, you've mentioned margin of safety a couple of times now.
Yeah.
What does that actually mean in practical terms?
Okay. Imagine you're crossing a busy street. You could just run across hoping you don't get hit.
Right.
Or you could wait for the crosswalk signal, give yourself a margin of safety. So in investing, that margin of safety means buying a stock for a lot less than what its intrinsic value is. That gap between what the price is and what the value is, that becomes like a cushion.
Okay.
It protects you in case your valuation was a little bit off.
So it's like getting a great deal, getting something on sale.
Exactly. And Graham actually, he provides a great example of this in the book. He talks about this company called Northern Pipeline Co. And he realized that the stock, it was actually trading for a price that was lower than the value of its bond holdings.
Wait, so the market was basically undervaluing their entire operating business.
Exactly. He saw this as this huge margin of safety. So, even if something went wrong with their business, those bond holdings provided a cushion.
Wow. Okay, that's an incredible example. So it's really about looking, beyond that stock price and actually digging in and understanding what the company's assets and earnings really are.
Exactly. It's like finding a treasure that the rest of the market has overlooked.
And that's really what the intelligent investor is always looking for, right? Those hidden gems that offer both value and a margin of safety.
Exactly.
Now, Graham doesn't suggest that like everyone should just, follow the same investment strategy.
Yeah.
He talks about different types of investors, right?
He does, yeah. He outlines two main categories: the defensive investor and then the enterprising investor.
All right. Let's unpack those a bit. What are the key differences?
So the defensive investor, they're someone who really prioritizes safety and stability. They're okay with, steady returns with as little effort as possible.
So they're not spending hours poring over financial statements.
Exactly. The enterprising investor, on the other hand, well, they're willing to put in the time and the effort to really research individual securities.
So they're more like the detectives that we were talking about,
Right.
actively seeking out companies that are undervalued.
Exactly. And Graham actually outlines, very specific strategies for each type, tailored to their risk tolerance and their goals.
I really want to dig into that, but before we get into those specifics, I want to touch on one of the things I find most refreshing about this book. Graham's willingness to kind of challenge those conventional wisdoms.
Absolutely. He's not afraid to debunk those myths that people have about the market.
Right, like he's calling out those too good to be true promises that, lure people in.
Exactly. And, one myth he really tackles is this idea that growth stocks are always the best investment.
Mm.
And he uses these fascinating case studies, companies like IBM and Texas Instruments, companies that were considered, growth darlings. But they experienced some pretty significant price declines.
So even those companies, with all the momentum in the world, past performance, it doesn't guarantee future success.
It doesn't, no.
So what other myths does he bust?
He also goes after this idea of market timing,
Which is?
the idea that you can predict, the exact best time to buy or sell a stock. And he points to this example where Alan Greenspan, a very prominent economist, he actually urged investors to buy stocks, right before a major market crash.
Oh, the irony. So even the experts can get it wrong.
Absolutely. Graham, he argues that, trying to time the market, well, it's just not possible to do consistently.
So what's the answer then? How does the intelligent investor avoid getting sucked in by all that?
They focus on building a solid portfolio, based on sound principles and then holding on to it for the long term.
Okay, so it's about the long game, not getting caught up in the emotion of the market.
Right. And another myth he tackles is this idea that stock splits actually create value. He uses this analogy. It's like having a dime and then you split it into two nickels. You still have the same amount of money.
Yeah, that makes it really clear. So stock splits, they're more about perception than anything else.
They are, yeah.
So it's really about looking beyond the superficial,
Exactly. Focus on the business.
the fundamentals.
Right. Now, before we move on, I do want to highlight another key part of Graham's approach: dollar cost averaging.
Okay, I've heard that term before. Remind me.
It's a very simple but powerful strategy. You invest a set amount of money at regular intervals no matter what the market's doing.
So instead of trying to figure out that perfect time to buy.
Exactly. And, it takes the emotion out of it.
Yeah.
You're not, tempted to buy when the market's super high.
Right.
And it helps you average out your purchase price over time. So you end up buying more shares when the price is low and fewer shares when the price is high.
Okay, so it's like a safety net.
It is. And Graham, he was really into using dollar cost averaging with index funds, those investments that track specific market indexes.
So by doing that, you're essentially creating this low-cost, diversified, disciplined strategy.
Exactly. And it can be particularly helpful, for for that defensive investor
Hmm.
who's looking for a simple way to build wealth over time.
Right, right. It's all starting to come together now, this picture of what it means to be an intelligent investor,
Yeah.
right? It's about having the right mindset, understanding the principles and choosing strategies that fit your goals.
And really, making those decisions based on facts and analysis and not
Yeah.
just, your emotions.
Yeah. I love how Graham's approach empowers individuals to really take control.
Right.
He's not saying you need to be, you know, uh, a Wall Street guru
Right.
to succeed.
Anyone can do it.
Now, I am really intrigued by this whole idea of the defensive versus the enterprising investor. I'm guessing our listeners are too and are wondering which one they are.
Right.
So, what are those specific strategies?
Yeah, let's get into that. That's exactly what we're going to explore in the next part of our deep dive. We'll take a look at those portfolio recommendations that Graham lays out
Okay.
and help you figure out, which path best aligns with your goals
Sounds good.
and your temperament too.
Great. Well, everybody make sure to tune in for the next part of our deep dive into the intelligent investor. It's going to be a good one.
It is. Okay, so last time we were talking about those two main types of investors that Graham describes, right? The defensive and the enterprising. So let's dive into their portfolio strategies,
Okay.
and we'll start with the defensive investor.
Perfect. So if I'm like, someone who really prioritizes stability and wants a pretty hands-off approach, what kind of portfolio does Graham recommend?
So he suggests a very straightforward approach. It's a balanced portfolio, with both stocks and bonds. Think of it like building a house. You got to have a strong foundation.
Okay, so like what kind of percentages are we talking?
He recommends this classic 50-50 split. So, roughly half of your portfolio would be in stocks and then the other half in bonds.
Okay, so a good mix of growth potential and then preserving your capital.
Exactly. And when it comes to that stock portion, you want to focus on those high quality, well-established companies, what he calls the, blue chips. Those companies that have a really long track record of actually making money and that pay dividends.
Yeah, the ones that have kind of, been there, done that, and weathered those economic storms.
Exactly. And for those bonds, he recommends a mix of taxable and tax-free bonds, depending on your tax situation. He even gives you an example in the book of how to, calculate those benefits based on your tax bracket.
So you got to do the math, see what makes sense for you.
Exactly. Now, that 50-50, it's not set in stone. He does say, you can adjust it like a little bit based on market conditions and, your own tolerance for risk.
Yeah.
So, like, if the market seems like it's really overvalued, you might want to tilt a bit more towards bonds. Or, if you're feeling a little bit more adventurous, you could shift a little bit more towards stocks.
Okay, so it's about finding that right balance for you.
Right. And remember, this whole approach is really designed for that investor who doesn't want to be spending hours and hours researching individual companies or trying to, time the market.
Yeah.
It's more of a set it and forget it approach.
Yeah.
Just let it grow over the long term.
Okay. Now, what about that enterprising investor? What kind of portfolio does Graham recommend for them?
So for them, he actually suggests a more like hands-on approach where they're spending more time and effort researching and then picking those individual securities.
Okay, so they're really, rolling up their sleeves and diving in.
They are. And Graham, he provides a framework for this portfolio. It's a mix of high-quality bonds, undervalued stocks, and then maybe even some more speculative holdings.
Okay, so it's more diverse than the defensive investor's portfolio, a little bit more risk, but with the potential for bigger rewards too.
Exactly. And he really encourages them to, look for those opportunities that he calls bargain issues.
Bargain issues.
Yeah, companies that are trading for far less than their intrinsic value.
Okay, so it's like treasure hunting, searching for those hidden gems.
It is. And he even suggests that they might consider growth stocks, but with a big caveat.
Oh, okay. What's the catch with growth stocks? Aren't those supposed to be like the big winners?
They can be, yeah. But Graham, he warns that, those growth stocks are often really overpriced.
Right.
And their future isn't always certain. He says even those companies that have, these really impressive growth records, they can experience those sudden reversals.
So you got to be realistic and not get too caught up in the hype.
Exactly. Approach them carefully and make sure there's a good margin of safety there.
So even for the enterprising investor, that margin of safety is still really important.
Absolutely. Now, This more active approach to investing, it does require more knowledge and effort.
Yeah.
So, it's not for everyone. The enterprising investor really needs to be comfortable with, financial statements, with valuation methods, and how the market works.
Okay. So they got to be comfortable with, digging in and doing the research. And also, they have to be disciplined to stick with it, especially when things get a little bit, rocky.
Exactly. Now, one of the things that really struck me about the book was how much emphasis Graham puts on that psychology of investing. He understands that it's not just about the numbers; it's about our emotions too.
Yeah, it's easy to kind of get swept up in those emotions,
Yeah.
right? The fear and greed and make some pretty bad choices.
Right. And to help investors navigate that, he actually introduces this really interesting analogy. He calls it Mr. Market.
Mr. Market. Okay, I'm intrigued.
So imagine Mr. Market as like a business partner you have, but he's manic depressive. And every single day he shows up at your door offering to buy your shares or sell you his.
Okay, that sounds a little unpredictable.
He is. Some days he's like, super euphoric,
Yeah.
bidding up prices to crazy levels, convinced that, everything's going to be amazing. And then other days he's all gloomy, offering to sell you his shares at like rock bottom prices because he's sure that, disaster's coming.
So he's driven by his emotions, not by logic.
Exactly. And here's Graham's point. You don't have to play Mr. Market's game.
Oh, okay.
You can ignore his emotional swings
What?
and make your own decisions based on logic and your own assessment of the company's value.
So it's about like seeing Mr. Market as an opportunity, not some kind of dictator.
Exactly. So, when he's overly pessimistic, you can maybe take advantage of that and buy some of his shares. And then when he's super optimistic, you can maybe sell to him.
Oh, that's really interesting. So it's about kind of detaching yourself from his roller coaster,
Right. Now, Graham, he does say that, it's not possible to perfectly time the market.
even with Mr. Market and his, craziness.
Yeah, even then. But, if you understand Mr. Market and his tendencies, then you can, make more informed, more rational decisions.
Okay. So, those market fluctuations, they're inevitable. They're going to happen.
Yeah.
But it's about not letting them throw you off.
Exactly. He actually says that the intelligent investor, they see those fluctuations as opportunities.
Not threats.
Right.
And they use them to their advantage.
Exactly. Buy low, sell high.
Right. Kind of like Warren Buffett says, be fearful when others are greedy.
Exactly.
Now, speaking of Buffett, I got to bring up the appendix in the book, The Super Investors of Graham and Doddsville.
Yeah. That's a good one. He's basically providing all this evidence for his value investing approach.
Right.
He profiles like 9 different investors, and they come from, all these different backgrounds, but they all had success and they all followed his approach.
And it's interesting because they had, they all had different styles and portfolios. Some were really concentrated, some were more diversified,
Yeah.
but they all had that one thing in common, right?
Exactly. They focused on buying businesses, not just stocks.
Right.
And they looked for that gap between the market price and the intrinsic value.
So they were truly Graham's disciples.
They were. And it's interesting because, they weren't just, Wall Street insiders. They came from all walks of life.
So it proves that anyone can do it.
Exactly.
Okay, one thing that I found really helpful was Graham's guidance on how to actually analyze a company and figure out that intrinsic value.
Yeah, that's a super important skill.
Okay, so let's talk about that. What are those key factors to consider when you're, thinking about investing in a company?
He really emphasizes understanding, the company's financial strength, their capital structure, their earnings, their dividend history.
Okay, so again, going beyond the surface,
Yeah.
looking at those fundamentals.
Exactly. He provides this whole framework for looking at financial statements, like being a financial detective.
Yeah.
And while that might sound, kind of intimidating,
Right.
he actually does a really good job at explaining it in a way that anyone can understand.
That's what I like about this book. It's not just for, financial experts.
Right. Now, he does caution against just focusing on those per share earnings numbers.
Why is that? I mean, isn't that a key metric?
It is, but, accounting can be tricky, and there can be these manipulations, that can distort those earnings.
So, got to think critically. Look beyond those headlines.
You gotta. He really encourages you to carefully analyze those statements and see, like, what the trends are.
Right. See what's really going on.
Right. And another really key thing he talks about is understanding the company's management and their stock policy.
Okay. So it's not just the numbers, it's the people too.
Exactly. He says that, good management that treats the shareholders fairly is crucial,
Right.
So he actually gives you these tips on how to like evaluate that management team, look for signs of integrity, competence, a long-term vision.
Yeah.
He also gives you advice on how to evaluate that stock policy too.
Okay.
He cautions against those stock splits, those buybacks
Right.
that can sometimes be used to manipulate prices.
So it's about finding those companies that are really focused on the long term, not just quick, moves.
Exactly. Now, for those who, might be intimidated by all that financial statement stuff, Graham, he actually offers a simpler way to find those undervalued companies.
Okay.
One way is to look for companies that are trading for less than their net working capital.
Okay, which is like basically buying a dollar for 50 cents.
Exactly. He also suggests looking for companies that have low price to earnings ratios compared to their historical average.
So it's about finding those companies that are, priced well compared to their earnings.
Exactly. But, patience is key.
Right. It takes time for the market to catch on.
Right. It does. And then another thing he gets into is what he calls special situations.
Special situations.
Yeah. So these are like, kind of unique opportunities
Hmm.
that come up because of, specific things that happen, like mergers or acquisitions or, even a company going bankrupt.
Okay, that sounds like you need some pretty specialized knowledge for that.
You do. It's not for everyone. But for that enterprising investor, who has the expertise and the tolerance for risk, it can be really rewarding.
So you're really looking for those inefficiencies in the market.
Right. Now, even though those special situations can be really appealing, Graham, he really emphasizes that diversification is still essential.
Diversification. That's not putting all your eggs in one basket.
Exactly. He suggests having at least 10 to 30 different stocks in different industries. It helps you reduce your risk and then, increases those chances of long-term success.
Okay, so even if one or two, of those investments, they don't do so well,
Hmm.
the others, they can help you, make up for those losses.
Right. And he says it's not just about, minimizing your chances of being wrong.
Yeah.
It's about, maximizing your chances of being right.
I like that. So you're capturing those good opportunities in the market while managing that downside risk.
Exactly. And diversification, it's not just about stocks. You also want to think about, bonds, real estate, and maybe even other things like commodities.
So, creating a portfolio that can handle the ups and downs of the market
Yeah.
and the economy.
Right. Now, Graham, he doesn't shy away from those psychological challenges of investing.
Yeah, we talked about Mr. Market, but there's got to be other, psychological traps that we should be aware of.
There are. He talks about things like, being overconfident,
Right.
anchoring, herd mentality.
Okay, so overconfidence, that's like, thinking you're smarter than the market.
Right. You overestimate your abilities.
Yeah.
And then anchoring, that's when you get like, fixated on a certain price or certain information, even if, it's not relevant anymore.
Okay.
And then herd mentality, that's like following the crowd, even when the crowd is, going the wrong way.
So it's really about being independent, thinking for yourself.
Exactly. Be rational, stick to your plan, and don't just, react to everything that's happening in the market.
Okay. So be the captain of your own ship. Don't let the winds, blow you off course.
Exactly. Now, for those who are, thinking about hiring some help, getting an advisor, Graham gives some good advice on how to choose one. He says it's really important to find someone who, shares your philosophy and who's focused on your goals.
Okay.
Ask them some tough questions. What's your track record? How much do you charge? Do you have any conflicts of interest?
Do your homework.
Do your homework. He also reminds us that even if you have an advisor, you're still the one who's responsible.
You're the driver's seat.
You are. Now, I do want to touch on Graham's skepticism of Wall Street and their obsession with, those growth stocks.
Yeah. We talked about that a little bit before.
Yeah.
Why is he so, wary?
He just thinks that they're often overpriced.
Right.
And it's hard to predict what's going to happen in the future.
Yeah. It's risky.
He doesn't rule them out entirely.
Okay.
But he says, approach them with caution.
Right. Make sure you're not paying too much.
Exactly. Now, he also provides a way to identify those bargain issues, those undervalued stocks.
Okay, how do we do that?
So one way, like we talked about, is to look for those companies that are trading for less than their net working capital.
Right. Buying a dollar for 50 cents.
Exactly. He also suggests looking for companies with low price to earnings ratios.
Compared to their history.
Exactly. And again, you got to be patient.
Yeah,
It takes time. Now, remember, even if you find a potential bargain, do your homework.
Right.
Really analyze those financial statements. Make sure you're comfortable with, how they're being run and their business model.
Be thorough. Don't just jump in because it seems like a deal.
Exactly. Another important thing that Graham talks about is those shareholder relations.
Shareholder relations.
Yeah.
Yeah.
He really encourages investors to be active owners, hold that management accountable. He believes that, as a shareholder, you have a right to know how they're using your money.
Right.
So, go to those shareholder meetings, vote,
Yeah.
speak up for policies that, are going to benefit you in the long term.
Yeah. Make your voice heard.
Exactly. Now, even though he, advocates for that shareholder activism,
Right.
he also says don't get too caught up in, those daily market ups and downs.
That long-term perspective again.
Right. He actually says that the typical investor would be better off if their stocks didn't even have a price that they could check every day.
Really? Why does he say that?
Because, when you're constantly checking that price,
Yeah.
it makes you emotional. You might panic and sell when it drops, or you might, get all excited and buy when it's high.
Right.
So, detach yourself from all that.
Okay.
Focus on the long term. Set that long-term goal, 25, 30 years. Stick to it.
So make that plan and don't just, react to all the noise.
Right. And remember, he wrote this book for, the everyday investor.
Yeah.
Not just those Wall Street guys.
That's what makes it so great.
Right. Anyone can be successful.
Now, I am really curious about some of that, more practical advice that he offers.
Yeah.
What are some things that our listeners can, take away and start doing today?
Yeah, that's a good question. And that's actually what we'll get into next time. We'll explore some of those actionable takeaways,
Okay.
and give you some concrete steps to get started on that path towards building a better financial future.
Great. Well, everyone make sure you tune in for the final part of our deep dive. You won't want to miss it. Okay, so we've talked a lot about, the intelligent investor, the difference between investing and speculation, Mr. Market, those super investors.
Yeah.
Now, let's get to the part I think everyone is waiting for.
Yeah.
Those takeaways, that our listeners can actually use.
Okay, yeah. So one of the biggest things, I always come back to is that long-term perspective. Graham, he really stresses that investing, it's not a get rich quick scheme.
Yeah.
It's a marathon. You got to be in it for the long haul.
So 25, 30 years, that's what he recommends, right?
At least, and resist that urge to just chase those, quick gains.
Right. Or freak out when the market takes a dip.
Yeah. And that long-term thinking, it really ties into, another key thing, patience.
Patience. Oh, that's a tough one.
It is. But, to be successful at this, you got to have patience. You got to have discipline. It's about, waiting for those opportunities, buying when everyone else is, running for the hills, and then holding on to those investments, even when things get rough.
Yeah, that's a really important message, especially today. Everyone wants everything right now.
They do. Here's another practical tip. Focus on those high-quality companies.
The blue chips.
Exactly. Those companies that have a long track record,
Making money.
Yeah. Paying dividends. Those are the solid foundation of your portfolio.
Okay. And even with those, rock-solid companies,
Mm-hmm.
you still got to make sure you're buying them at the right price.
You do. You always got to remember that margin of safety.
Right.
Even with the best companies, you don't want to overpay. Graham, he gives you all these different methods to try and figure out what a company is really worth. And then, you buy it at a discount.
So, kind of finding those hidden deals.
Exactly. And that brings us to, that dollar cost averaging. We talked about it before.
Right.
But it's worth repeating.
Yeah.
Don't try to time the market.
No one can do that.
You can't. Just invest a set amount of money, regularly, no matter what's happening.
Okay, so it's like a savings plan.
It is. And Graham, he was really into using that strategy with index funds.
Right.
Because it's low cost, it's diversified, it's an easy way to track the market.
Right. So it's a simple approach, but an effective one.
It is. Here's another one that I really like. Don't compare yourself to others.
Oh, yeah. That's a tough one these days.
It is, with social media and all that. But Graham, he makes this point that, you're not poorer just because someone else is doing well. Focus on your goals, not what everyone else is doing.
Run your own race.
Exactly. And for those who are, feeling a little bit overwhelmed
Yeah.
by all this, the financial statements, picking stocks,
It can be intimidating.
Graham has a really good message. You can still be successful, even if you're not, a financial expert.
Okay, that's good to hear.
He says just follow some, simple rules.
Like,
Diversification.
Yeah.
We talked about that. Don't put all your eggs in one basket.
right.
And keep your costs low.
Right. Watch those fees.
Yeah, and don't chase performance. All that stuff, it just eats into your return.
Okay. So,
Yeah.
be mindful.
Be mindful. And, Graham, he also says keep learning.
Yeah. So it's a lifelong journey, this investing thing.
It is. You got to stay informed. The market changes. Things change,
Got to be able to adapt.
You do. So, as we wrap this up, I want to leave you with a question that Graham asks in the book. What's that one principle, from this book that really sticks with you?
Yeah.
And how can you start using it today?
Yeah, that's a good question. Think about what you want, what you're comfortable with, and what kind of investor you want to be. And remember, you don't have to be an expert to be successful. Use your common sense, keep learning, and you can do this.
Well, that's all the time we have for our deep dive into the intelligent investor. We hope you found it helpful. And, we're confident that you're now well equipped to start building a brighter financial future.
Absolutely.
Thanks for tuning in.